Walgreens Boots Alliance, ticker symbol WBA, is currently trading at $8.72 a share. Year to date, this stock has been absolutely hammered, down almost 68%. It was previously trading at $27 a share and is now, as I said, at $8. Now, one thing that people do like about this stock is it's currently paying a massive dividend yield of 11.47%. So what we're going to be doing today is looking at my automated stock valuation spreadsheet, seeing if it is a buy, is it undervalued, or is it a value trap? And we're going to be looking at my discounted free cash flow model, the comparable company model, dividend discount model, and of course the Ben Graham formula for intrinsic value. So as I said, we'll just have a look at the 5-year chart. In fact, we'll go a bit further out. We won't be talking about these times. It was certainly happier times, but it hit all-time highs in 2015 at around about $100 a share, $95 a share, and since then it's had a 90% decline. In the pandemic, got hit pretty hard, recovered up to about 50, and then since then has been on a downward trajectory. So let's have a look at my automated stock valuation spreadsheet. If we put in the ticker WBA, this will load all the latest company financials. $8.72, market cap of $7.5 billion. PE is not returning, so that means it is currently not profitable. And we can see here from the net income that it is not profitable. Market average of PE is around about 30, but not necessarily relevant here. Earnings per share minus $6.74. A beta of 0.7, meaning it's a lot less volatile than the market. And analysts do say it is a buy with a target price of $11.39 a share. Now, talking about that dividend, yes, $11, that'd be excellent. 11.5%, meaning you will get $1 per share. Now, it is not a safe dividend currently because in the trailing 12 months, both of these are negative. Now, previously they did have around about $4 billion in free cash flow. So the free cash flow payout ratio would be around about 25%. And net income, we go back there, it would have been about 20% as well. But currently these are negative numbers, which is not very good. So it does not look particularly safe. But if you want to buy the stock and get paid that lovely dollar, let's see if we can get it from Dividend Max. Walgreens, Boots Alliance, don't know why ticker symbol WBA didn't work. If you buy the shares before November 12th, you will get paid that money. So let's have a look at revenues. Revenues, all-time highs, interestingly enough, $145 billion. Increasing, as you can see here, steady growth in terms of revenue, especially for revenue of this size, but it is growing and hit all-time highs. So that is interesting to see. Net income, obviously a different story, was very profitable, about $4 billion, then dropped off a cliff in 2023, and then again in the trailing 12 months, minus $0.81 billion. Free cash flow, similar-ish story. It was sort of steadily decreasing. 2023 was still positive free cash flow, 140 million, and now is in the negative of 890 million. Shares outstanding, what are they doing? Well, they were having a pretty aggressive buyback program up until 2020, and then the shares have stayed flat, maybe a little bit of a buyback here, as you can see, at 0.87 to 0.86. So let's have a look at my discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. And based on averages, minus $20 a share. So let's have a deeper look into these numbers and see what we see. So we're expecting 0.85% growth based on these averages, 146 and 148 billion in revenue. Let's see what Yahoo Finance says. About what we're saying. They are expecting minus 21% growth over the next 5 years. Wow. Okay. Net income margins, historically, they have been positive. So let's just put it a little bit. Let's say 1%. Oops, sorry, 1. Oh, that would put it $149 stock. Okay, let's have a look at this here. It's because these free cash flow net income margins. Yeah, I mean, if we look at the averages, that's probably not fair. If we look at the trailing 12 months, around about 15%, that puts it at about an $8 stock. Sorry, $6.48. So still not a buy on discounted free cash flow amount, and that is with it being profitable with a 1% net income margin. So discounted free cash flow model is not looking too good. Sorry guys, just having a drink of water, a bit of a cold, but I wanted to do this video. Dividend discount model. It looks like it hasn't taken the last year into account, or maybe, oh sorry, they've cut the dividend according to this. But expected growth is quite high. Yeah, intrinsic value of $225 a share does not seem, pardon me, particularly correct. So we'll move on. Ben Graham formula for intrinsic value. It won't like this because obviously we saw the growth is negative of minus 21%. Oops, sorry, I've just overwritten there. Minus 21, minus $5. So for this, sorry, it does have a negative earnings per share. Sorry, this was a manually override video I was doing on a prior video, which I think I'm releasing after this, because I think this will be better out on tomorrow, and then we can release the other video later in the week. Just playing around with the schedule in there. Anyway, finally, comparable company model. What this is looking at companies of similar size, and we're looking to see if it is fairly valued based on their competitors. Now, actually, the one I'm going to do is I'm just going to do one comparison, and I think the sort of closest is CVS, which is the CVS Health Corp. Now, if we just go to comparable company model 1, we can have a compare. So in terms of enterprise value, CVS is a lot bigger, 150 billion compared to 40, about double the revenue, a little bit more. CVS has good revenue growth, 13% compared to 1. Profit margin is about 2% compared to the -% currently. Lower PEG, which is Peter Lynch's price to earnings growth. EV to revenue, EV to EBITDA. In terms of EV to revenue, it is actually undervalued at $46 a share. Not so much on EV to EBITDA because of the negative earnings, -42, and currently doesn't have a PE, so it doesn't have a value. So yeah, I would say based on these models, it's not a buy. Pardon me for the coughing. If we were to compare Walgreens to CVS over the 5-year period, CVS up 3% compared to Walgreens down 83, which is obviously crazy differences. Even the last year, they're down 60% compared to CVS is 7. Right guys, thanks for watching. Hopefully you found this interesting. If you're interested in my sheet, check out my Patreon, subscribe if you're not already, and I'll catch you guys next time.